Goldman Sachs forecasts only a 3% gain to the S&P over the next 10 years, and when we take a look at their prediction for the end of 2025, they see 6,500 points. Even Tom Lee, who had a very strong prediction for 2024 that was pretty much in line, whilst he sees 7,000 points by the middle of 2025, he believes by the end of next year that will retreat to 6,600, and when we take a look at it right now, we are only talking about a 10% gain. So today we're looking at dividend stocks with not only more than a 10% gain over the next 12 months, but also those that pay a very nice dividend. And we're starting off with AbbVie today, a global biopharma company. They develop market drug in areas like immunology, oncology, neuroscience, and aesthetics, and they're well known for some very large products like Humira as well as Botox. In terms of the company's performance, well, over the last year, they have underperformed the S&P, up 15%. Over the last 10 years, not far off the S&P, up 170%. And right now, they are trading in the mid to lower end of the 52-week range, with a double buy rating from Seeking Alpha and Wall Street. As we can see, they also pay a fairly attractive starting yield, 3.7%, with the forward PE sitting at 16.3. Now, each one today, we're going to look at the earnings as well as other data, and what we can see over the next 4 quarters for AbbVie, they are expecting growth to the EPS year on year. Over the last 4, they have actually only outperformed in 2 of them, although the 2 that they did miss were very marginal. Nonetheless, 50% track record, and if you do believe they'll hit their December 2025 earnings per share estimate, that will in turn lower the forward P to 14.6, and that in all honesty is what we see their forward P right now, as that is the next full year. In terms of looking at their growth, again, we'll look at each one for this metric. They get a D-. Now, one of the main reasons they have lagged in terms of revenue historically as well as over the next 12 months in comparison to the sector median, but we also notice, and one of the most important metrics we like to draw your attention to, the earnings per share over the next 3 to 5 years coming in marginally under. Again, this is just expectation, 8.8% versus the sector median of 10.7. We'll also very briefly just touch upon the dividend safety. Again, these are dividend paying companies. We want to ensure they are safe, and we can see we get that today with the 80 score. Now, these are some valuation metrics that we do talk about in our deeper dives. We're not going to cover them today, as we will go through our own valuation process now, though we can see the most recent increase to their dividend was in October at 5.8%. As we said, for each one of these companies, we're going to run them through our own valuation process. For AbbVie, the intrinsic value today at $207 is ultimately the average of these 3 that you do see on screen. Now, as we said, we do deep dives on this channel where we run through the inputs and outputs. Today, we just want to get straight to it. We're covering 7 different stocks, and we do like to use a 10% margin of safety at the starting base. Execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that in today's episode, a buy at $187, then we keep going till it's near the current trading price. And in today's episode, we see a 15% MOS, with Wall Street themselves fairly bullish. We did get the buy rating, 21% upside, their price target $215. So is this one you are considering? 3 to 4% yield, 15% MOS, 21% upside, and as we say and we go along today, do give us your thoughts in the comments below. And then we move on to PepsiCo, a global food and beverage company that produces and markets snacks, beverages, packaged foods, and they have some very well-known brands: Pepsi, Lay's, Gatorade, as well as Quakers. Now, this is a company that hasn't had the best last year, down 10%. Over the last 10 years, not great either, only up 62%, but right now could be a great opportunity, trading right there at its 52-week low. All 3 analysts now consider this company a buy, and we can see, similar to AbbVie, a fairly attractive starting yield, 3.6%, with a forward PE just below 19. In terms of the essential earnings, well, green right across the board. I'd love to see that. Growth over the next 4 quarters anticipated, 100% historical forecasting accuracy, and with their December 2025 EPS, which is what we would say their forward PE right now is, that sits at just under 18. In terms of the growth, not the greatest. Again, it does lag in terms of the historical performance in focusing on revenue. However, forward-looking, marginally higher than the sector median. And again, the one we want to draw your attention to, the earnings per share, 5.6. That is similar to AbbVie, coming in marginally under the sector median. Nice to note, a very safe dividend score at 93, double severe undervaluation signal, and we also noticed they did increase the dividend in February this year at a high single digit, meaning in the next few months we are anticipating for PepsiCo another dividend increase. So in terms of the valuation, well, $173 is what we get to today. And remember, you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Pepsi or any others. So MOS at 10%, a buy at 156. At 15%, not quite there, but also not far off. So for PepsiCo, a recent dividend king as well. That means essentially 50 plus years of consecutively increasing the dividend. You're looking at 10 to 15%. With Wall Street, again, we did see a triple buy rating. Their price target, $185, 22% upside over the next year. And as we said, each one of these is looking to outperform the S&P at least in 2025 based on predictions. Now today's video is sponsored by Snowball Analytic. Now this is a high quality portfolio tracker and it does a lot more than just maintain the data of what companies you're invested in. In fact, there are many different features that you can use right now. For example, when we look at this dummy portfolio, as you can see, the different sectors showing how much money you've invested in. For example, if you want to increase in one certain industry or maybe reduce some exposure. It also talks about why certain companies are down, just in case you don't have time to research. You do get a quick snapshot. As we said, the user interface is very friendly to look at. It is one we use ourselves, and there are many different ways that you can customize the information that you want to take a look at. For example, those that prefer to specifically look at dividends, you can not only see your yield payout, but also, most importantly, your yield on cost. Ultimately, we do want to see this rise over time. You can also take a look at the dividend safety. As we said, lots of different features if you want to compare your performance against the S&P. If you also want to take a look at your portfolio's PE, the volatility against the overall market. One thing that we quite like to see, especially for those that want to buy companies that come in certain months for the dividend, maybe you lack in December, January, you can take a look to see not only when your dividends are coming in, but also taking a look at the payout calendar to understand, for example, to see that here Waste Management does pay in December and they pay on the 20th. If this is one that maybe you lack, again, something to consider. Finally, and maybe one of the most interesting aspects, is just by searching any company in this database, you can take a look at some of the fundamentals, the underlying metrics. We can see here there is quite a lot of information, but it doesn't just stop there. If we take a look at the financials of Johnson & Johnson, we can clearly see here their income statement, their revenue growth over the longer term. If you want to take a look at their balance sheet, the same again with their cash flows. There is a free trial, and right now they are doing a 30% discount. So again, check that out. Click on the pinned comment below. We then move on to Google, very well known, specializing in interrelated services, products, search engines, advertising, cloud computing, software, and obviously they are very well known for YouTube and their Google search. In terms of the company, well, over the last year, it has marginally outperformed the S&P, up 37%. Over the last 10 years, massive outperformance, and even with the run we have seen in 2024, notably just over the last few weeks, we still believe this to be a very top contender for 2025. We also get a double buy rating from Seeking Alpha on Wall Street. Now 4.5 would turn this into a strong buy, so not far off. And Quant, even though they have given it a hold at 3.49, not far off the 3.5 to flip this into a buy. Now they do pay a yield, one of the lower ones we will look at today at 0.42%. And when we take a look at their earnings, not only green right across the board, but 2 of the next 4 quarters, they are expecting double-digit growth and a fairly sizable miss in the most recent quarter. Now based on the December 2025 EPS, we see the forward PE right now sitting at 21.5, and that is the cheapest Mag 7 right now. Now growth, they do get a C+, although we don't necessarily agree. If we look at the revenue on a historical basis and on a forward basis, both double digit, significantly better than the sector medians as we can see clearly. And we also notice the earnings per share also expected to be significantly better than the sector median, 16.5 versus 10.9. We also notice, whilst they have only recently started to pay a dividend, the score does look to be safe at 80, and that is something that we do agree with. In terms of the valuation, well, $215 is what we arrived at today, and in terms of margin of safety at 10%, that is pretty much where we see that. Maybe not as high as the previous companies and as the ones that we will get along to in the episode, but definitely one we believe as the best opportunity in 2025. And we also notice Wall Street themselves fairly bullish, $225 price target, 17% upside over the next year. And as always, do give us your thoughts in the comments below. We then move on to Merck & Co., which is a global pharma company that develops and manufactures medicines, vaccines, animal health products, and known for products like Keytruda and Gardasil. Now, in terms of their performance, not the greatest, down 8% in 2024. Over the last 10 years, up 74%. Again, another similar one trading towards their 52-week low with a double buy rating from Seeking Alpha and Wall Street. A nice dividend yield, 3.3%. A forward P looking very low at 12.9, especially in relation to the S&P's 25. And we also like to see this nearly green right across the board with their December 2025 earnings per share estimate, lowering the forward P to 10.5. When we look at their growth, also fairly attractive at an A. In fact, when we do look specifically at the earnings per share, they're looking at some very large growth, 41%, significantly higher than the sector median at 10.7, and we can also see a very safe dividend score of 90, whilst also an undervaluation on dividend yield theory and towards the lower end of that reasonable signal. We also noticed a 5.2% increase just last month. In terms of Merck & Co., well, the valuation also looks very good. $126 is our intrinsic value, and as you would expect, a fairly nice margin of safety at the 20% point right now, with Wall Street fairly bullish again, $128 price target. There's the upside of 28% into 2025. Now, we also want to let you know we have released our latest free weekly article where we talk about two stocks that look like massive buys after the market drop. Now, we release one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, start reading straight away, where you'll also be able to gain access to 28 undervalued stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year, and we will soon, over the next few days, release the January version, so make sure you have signed up. And you can also right now grab a copy of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, sign up, and you can start reading straight away. We then move to Zoetis, which is a leading animal health company that develops and produces medicines, vaccines, and diagnostics for pets and livestock. Their products aim to enhance animal health as well as productivity on a global scale. And when we look at this company, they are down 17% over the last year. Over the last 10 years, though, they have still massively outperformed the S&P, right now trading in the lower end of the 52-week range, a double buy from Seeking Alpha and Wall Street, a forward yield of 1.22%, and when we take a look, nearly green right across the board. Great to see growth anticipated into 2025, and when we look at their December 2025 EPS, their forward P right now sits around 25.7. In terms of their growth, well, they do get a C, although we do notice a marginal increase of revenue in relation to the sector just over the last 12 months, and we can see here a marginal decrease of 8.9% versus the sector comparison at 10.7. Great to see as well that safe dividend score of 74, severe undervaluation on both of these models, and we can see this month they did increase that dividend double digits at 16%, something we always love to see. In terms of valuation, this may have a very large margin of safety, as we can just see from the difference between the intrinsic value and the current price. Now, 30%, not quite there yet. We're seeing between 25 to 30% MOS, with Wall Street themselves very bullish, $215, 31% upside. And when we have done a deeper dive on Zoetis, it actually has some very high quality metrics. But if any of these companies we go through today, you want to see a closer look at the numbers, do drop your thoughts below and we can follow up in another episode. We then move on to Novo Nordisk, a global healthcare company specializing in treatments for diabetes, obesity, rare endocrine disorders, and best known for their insulin products as well as GLP-1 therapies. Now, this company did in fact fall quite considerably just over the last few weeks, although over the last year down 16%. Over the last month, again, we can see that is pretty much the bulk of the drop. Now, we did a deep dive explaining why, in fact, they missed analyst estimates, very small in terms of one of their latest products. But again, check that episode if you want a closer look at the numbers. Nonetheless, still massively outperformed the S&P over the last 10 years, trading towards the lower end of the 52-week range, a double buy from Seeking Alpha and Wall Street, a forward yield of 1.7%, and we can see their next quarter, they are anticipating 23% growth to the earnings per share with a historical 75% track record. Right now though, with their earnings estimate of 3.88, we do see their forward PE coming in at 22.5. In terms of their growth, nice to note A-. In fact, revenue on a historical basis and a forward basis, both strong double digit, a lot better than the sector median, and we can also see over the longer term, it is expected to outperform in terms of earnings per share, 14.6 versus 10.7. We also love not only the very safe dividend score, but that is the highest score obtainable at 99, double undervaluation signal, and this company does increase their dividend at a very rapid rate. In fact, as we can see here, over the last 5 years and the last 20 years, that is something that continues to shine through. Now, when we talk about Novo Nordisk, also the valuation does look very attractive right now. Your attention probably goes on to Wall Street with their forecasted price at $148. This has been unchanged even after the news that did come out, and they see 70% upside. This is one that could really propel your portfolio in 2025. And in terms of our estimation, when we do get to the margin of safety today, not quite at the 30% level just yet, but you are getting pretty much 25% MOS. And again, if you do believe Wall Street and their estimates, that is a lot of upside into 2025. We then move on to L3Harris Technologies, an aerospace and defense technology company that provides communications, electronic warfare, as well as surveillance solutions, and it serves customers in government, commercial, as well as the defense sectors. Now, in terms of the performance, they're up only 1% over the last year. Over the last 10 years, though, they have marginally outperformed the S&P, right now trading to the lower end of the 52-week range with a double buy from Seeking Alpha on Wall Street, a fairly respectable 2.2% yield, and when we take a look, green right across the board, as always, one of our favorite things to see, and based on their earnings per share, we do estimate right now the forward P sits at just under 15. In terms of their growth, while they do get a D-, we can see they did perform better in terms of revenue against the sector median and also a little bit better estimated into 2025. Although one thing that lacks one of the reasons for that poor rating overall, but we would say only a very marginal difference, 9.1 for the earnings per share, the essential sector coming in 11.5. Nice to see though a respectable 80 score on the dividend safety, and one thing that we actually don't like to see is that very low dividend increase at 1.8%. That is below essentially the average inflation rate of 4%. In terms of the valuation, we get to $301. Again, very respectable margin of safety in today's episode. And as we keep going, we can in fact see you're getting around 30% MOS with Wall Street and their buy signal $288 over the next year, given that 36% upside. As always though, do give us your thoughts about these 7 dividend stocks, whether you're accumulating any, maybe they're on the watch list, or for whatever reason they don't fit your overall portfolio and investment thesis. Don't forget to sign up to the free weekly newsletter, grab those spreadsheets. Also check out Snowball Analytics in the pinned comment below, where you can grab a very good 30% discount, and in fact, why not take advantage of the free trial? And you can come and join us in the Patreon below, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.